Hello and welcome to the Investing Master Series. My name is James Boyd. Today's date, June 16th. It actually hasn't been too hot in Salt Lake City, which is kind of nice. So hopefully wherever you are, it's nice summer conditions. Let's go ahead and get started. This is live, but also it's being recorded as well. So I'll share with you that playlist. That way you can bookmark that in just a second. We'd like to welcome with us Silas, Will, Barbara 2.0, the Canadian Flaggy. Okay, she's with us. Got to always mess with her a little bit. It's just too easy being Barb sometimes. Living that easy life. Anyway, a little fun with Barb. Okay, that history goes back a while. Olga, Robert, Tech One Trades, Will, and many others. Good morning. Let's go ahead and get started. Now, remember, Barbara and myself, all of us coaches, we post educational content on X. There's my handle. Barbara will post her handle in the chat. That way you can click on it and just follow Barbara as well. Now, just real quick as we get started, when we discuss our examples will be stocks and options. Sometimes we focus probably more in short-term trades, maybe 2-3 days to 2-3 weeks, 2-3 weeks to 2-3 months. We're kind of looking for that sweet spot, 2-3 days to 2-3 weeks. Okay, that's the sweet spot we're looking for. Kind of think of it as more intermediate type trades. Now, in our examples, we'll do stocks and options. And if we bring up options, remember that options carry a high level of risk, not suitable for all investors. All options are not the same. Also understand when we talk about examples, as I talk about the information, we'll talk about those where you should not consider them an individualized recommendation. They're examples. When we do our examples, we will do those on the Paper Money software application for educational purposes only. Continue to practice, very important. When we talk about investing involves risk. Also, when we talk about, let's say, examples of short options like covered calls, okay, selling calls, selling puts. Remember that those are obligations. And if those are American style options, which most of our examples, if not all are, those could be assigned at any time up to expiration, regardless of the in the money amount. So you just have an understanding of what that means. Okay. And also, when we talk about our examples, we'll talk about market conditions first. We had a question on crude oil and airlines. We'll kind of maybe broaden that a little bit to transports, but we'll talk about kind of some of the market conditions we're seeing with the big four. When we say the big four, we're talking about VIX, crude oil, US dollar, and interest rates, and how that's actually playing out with the four indices and sectors. With that said, let's go ahead and take it away. Now, as we do this, just understand that we need to look at some past examples of positions that we practice together. We need to do that because some of them are just kind of at the point of potential profit taking. Now, if we look at the SPX, really the SPX, and I'll kind of minimize those down at the bottom for just a second. When we take a look at this, what you're now going to notice is we've had that crossover, right? Now, again, we started with the 10-period moving average, then we actually got the 20 yesterday. It looks like step 2 and 3 happened at the same time. That was yesterday. Now, someone might look at this and say, red candle, this is a false breakout. We wouldn't say something like that because it's barely down. First off. Second, when we actually get the breakout date, the second day tends to be the red candle. So this is not unusual. Obviously, your eyes are on the moving average level, which is about 74.25 and so on. Again, you're going to be watching the big four, the VIX, the interest rates, the US dollar, and crude oil. And again, those big four have kind of been the big independent variables that have been a pretty good indicator as far as what the equity markets are actually doing. Speaking of that, now by the way, when we actually look at the SPX, here we are at the prior high. The prior high at 96.15. We're only about 1% off that high. That's it. When you look at the SPX EW, the equal weight, that made another brand new high here today. So you can't just say it's technology. Can't say that. Okay. And if you look at, let's say, the VIX, this is one of the four. The VIX, can I get a hallelujah? Okay. VIX did get above 18 for a little bit, didn't last very long. And this is why some people say when the VIX is high, it could be the time to buy stock or ETF. Maybe some people like ETFs, whatever that investor considers. Some people say when the VIX is high, with a Southern accent, it could be the time to sell some pets or sell some put spreads where the volatility is higher and the premiums could be bigger. Now, here we are down here. Let me guide your eyes almost down the bottom of the chart. Literally down at 16. What's that low we actually had recently? 15 and a half. So remember, that VIX dropping usually means that stocks on a majority basis are up. US dollar. Are people putting money into cash, driving up the US dollar domestically and internationally? Lately, we've actually seen the US dollar come down a little bit. We've also seen, when we look at, let's say, the rates, the 10-year kind of down near the recent lowish area. We haven't seen that also kind of mimicking the drop in the VIX and the US dollar. 4.43, move the decimal over 1. And if we look at the kind of the big driver here is that crude oil stuff. Now, that crude oil just falling through the floor. And some people are like, oh, yeah, I like that. Okay. Some of you are thinking about selling your truck for a scooter. Maybe you're going to hold off on that. Now, if we take a quick look at this, we talked about kind of when we talked about the pricing, right? The ones with shorter maturity versus longer. Last week, when I think we looked at it, it was like 86 to 80. If you look out far in time at the end of the year, now it's actually literally sitting at 77. Well, actually, yesterday it was at 80, and getting into the end of the year is like 75. So we are seeing it's not just the current month actually dropping, the further out months are dropping, which many investors really like to see. Now, we had talked about the relationship of oil compared to discretionaries, okay? Meaning if you had to spend less money on gas, you might say you're going to go out to a restaurant. You're going to go out to, let's say, so restaurants. We could also say, let's say, clothing, okay? Miscellaneous items, okay? Discretionary. We could also say travel. Travel could be example given, if I brought up one, could be Marriott, okay? Could be Hilton, okay? And if you look at these, as that price has actually gone down, speculation that people might be more willing to travel. Now, Airbnb has been the softer of those, okay? Airbnb, but with the kind of the price in, let's say, oil dropping, you did see some reaction even from the one that didn't correlate as well, Airbnb. Now, if we're bringing up the airlines, and I think we talked about that once or twice. Okay, wink, wink, because that's not true. Probably talked about it 10 times and some of you got sick of it. UAL. Now, the question was, why, with oil doing what it's doing, why is airlines, let's talk about the three that we talked about, UAL, Delta, and Love. Okay, now, so sometimes this becomes a trade, right? The speculation was that oil was going to drop to some degree. And that price from low to high, I mean, I'm talking about just in the last week, it only went up 22%. So sometimes what happens is we think oil drops, so therefore airlines has to go up. That's not how correlation works, okay? Now, we said the three. If we said, hey, what is UAL doing here today? Let's go back to kind of, well, why are we not getting the little bump? Well, some people might have actually gone to our class, and we always kind of talk about, does the investor consider buying stocks at 10% above the 10-day moving average? Well, if the market had come to our class, we don't typically talk about buying stocks at the 10 period, at 10% above the 10-period moving average. That's where more investors like to sell stocks, typically, not always, typically. So it's not that someone says, I hate airlines. The timing might not just be great. Okay, does that make sense? Now, that doesn't mean all of them look like this. Let's go out and look at the others. So when the prices pop, some people might say, James, we're at that 10-period moving average. I want to try to sell something. Let me show you something. When we went to the 10 right there, sold off. We went to the 10 right there, sold off. Went to the 10 right there, sold off. Went to the 10 right there, went up a little bit more. 2 days later, sold off. We went up to the 10. Geez, you're saying the same thing over again. I'm just kind of helping you understand. Say thank you. Having a little fun with you. Now, what you're going to see is what's likely going to happen. Well, many investors might think, could that pattern repeat itself? So think of this like you could think of it like Bollinger Band. Statistically, what are the odds of the price getting that high away from the support level and or moving average? Same idea. Okay, now for some of you who are not aware, I can't imagine that this is you, but let's say it was. That 10 period moving average, that's the light blue. 3% above that, that's the yellow line. 5% above is the red. 7% above is the white. And the dark blue is the 10. Now, 10% above the 10-day moving average. So again, if you kind of saw a history of where investors were likely going to sell, why doesn't it go up? Well, this is why you want to pull up the tools. Okay. Now, yesterday when we rocket shipped above that, you should pull up those tools and say, geez, are people more likely going to buy or sell? And if we get above the 10 period moving average, on a majority basis, probably sees more selling than buying. Sometimes those stocks can get above there, but that's pretty rarefied air. Now, well, what about Delta, James? Come on, don't be so negative. Well, if you look at Delta, it's kind of very similar to what we saw historically. Okay, there, we didn't touch it there. Delta has actually done it really one time, two time, and we did not get as high, but Delta did get to the 7. Now, if we pull up Love, where does Love stand? Well, Love, okay, was the one that was not in the upper bands, if you will. They were on the lower band. Love also pushed to the upside. And really, we were kind of between the white and the yellow. We actually touched the 10 yesterday. So sometimes what happens is the correlation is playing out not at all because some of the stocks might have gone up more. It's Love that's getting the push, okay? 4.5%. So don't think that, hey, if oil's down, all stocks are going to be up or down the same amount. They could have been bought up more aggressively, some more than others. We know that Love lagged. How do we know that? Well, because Love was in the basing pattern and it finally got the reversal. Does that make sense? Now, let's kind of pull something up. We need to just verify together, okay? Let's all get on this ship together. And I want to look down just real quick and see if there's any positions. So, just hits me right in the face. So when we look at the margin, you're going to notice on Love right there, 100 shares of stock. Now, as an investor, I am talking to you. If you had 100 shares of stock and you were seeing that the price was hitting, let's say, the upper band, what strategy might you consider? Now, currently, there's 100 shares. What would you consider? Type it in the chat. Now, I'm going to look down here. If you don't mind me, I'm just going to look and see if there's any other airlines in there. Okay, so let me go to the IRA. I'm just double checking. Type in the strategy. Oh, so there's another one, right, in the IRA. So there's one. CSX, we need to talk about. That's transports. And if we went down, there it is. Okay. Now, so just so we're here, okay, UAL, the only example we really have. Now, is this a vertical or is this more of a cash secured put? So what we're talking about right now is Southwest Airlines, the stock positions that's in both the portfolios. The second trade we're talking about is UAL. Now, why do we want to talk about the timing? Well, if we're sitting in here on UAL, we sold the 100, okay? How do we know we sold it? Minus. Bought the 80. Now, this is not your typical vertical, short put vertical, because the spreads will be tighter. Yeah, it's a wide put vertical, okay? Now, so tell me what I should do on this position. Now, you can tell me what I should do. Go ahead, tell me. Now, some of you like to kind of be in control. Control this portfolio, example given. You know, some investors might say, James, you sold that in the pay money account for $5.90. It's at $1.17. Now, we got to ask ourselves, did that go lower than that yesterday? And the answer was, yeah, it sure did. Okay. Now, what percent of the maximum gain do we have so far? Got 80%. Now, the investor, now I kind of think of this like if you went to a barbecue place and you ate this big rack of rib, and just on your hands, you got barbecue sauce all over. Now, remember, you just ate 80% of these ribs, the meat on the ribs, and that last 20%, you're just licking the barbecue sauce on every one of your fingers. Now, if you were there sitting by yourself, maybe that might be appropriate, but it might gross the person out across the table from you. Okay. Meaning that if the investor says, look, I got 80% and I got more than 31 days remaining. Okay. Could someone be greedy and be not taking the 80% and licking their fingers? Oh, they could try to get that last 20%. So the big thing is we're going to right click on this, create closing order. Now, let me know if you know anyone that does that and you get grossed out as well. Okay. Now, don't put their names in the chat, for crying out loud. Now, what I'm going to do is I'm going to put that mid right there, mid 118, and we're going to go confirm and send. Okay. Now, gee, wait. You're not buying the put. You're not selling the put. That's true. The put's only worth 10 cents. So there's not a whole lot to sell there. Okay. Does anybody know why we're not rolling this? Does anybody know why definitively we are not rolling the position? There's a specific reason. If you caught yesterday's class, you know. The reason why we're not rolling the position and like saying, hey, we're going to buy the put back and sell another one, it goes back to the timing. Okay. So in that timing, when we talk about, let's say, what's A? A is kind of in between the light blue and the yellow. B, red, yellow to red. C, between red to white. And then D, kind of like a D entry. Think like grade school, right? And if you said, look, I'm going to put a position on above the 10-day exponential move, above the 10% envelope, we think of that as like F grade. And the timings, you're elevated off that support level. We could visually see it. So we're not, now I know I'm on love. I know that. But if I brought up UAL, and if those prices were above the 10-period moving average on UAL, we're profit taking, not rolling. Now, if we saw UAL drop back down, could we try to sell another put and then use the current short put, use the current long put as that offset? And the answer is, yeah, absolutely. I'm going to try to. So trade number one here is we're going to try to get out of that 100 put there. And now just because we put the order in doesn't mean it's going to fill immediately. We need to double check. Okay. We'll give it 2 to 3 minutes. If it doesn't fill, we're going to come in and move it around. Now, I want to go back to the question I asked before. Okay. Yeah, Tech One, Tech One says, are you hungry? I don't know. It's almost lunchtime. Okay. Now, here's the deal. I want to go back to Love just real quick, and I want to look and see the answers that I was getting. Okay. So a lot of times people talk about adjusting strategy, and you have a stock that Love, Southwest, that's actually hitting that 10% envelope. What type of strategy? Now, if I'm reading I'm going back on the chat, and I asked the question like, what type of strategy would you do? I think some of you actually said maybe consider exiting. Now, some people might not do that. They might say, look, James, do you have 100 shares of stock? So instead of maybe selling the shares of stock, they might say, is it possible to maybe do like a covered call? Okay. Well, I don't know. Let's go double check. Now, remember, when we actually talk about selling call, we're going to go look at the monthly options, 20 to 50 days to expiration. We're going to look at the monthlies first. So we're still looking at the 17th of July. They have 31 days left. That's the area that we're going to start. Number two, we're going to go look at the implied volatility. Now, 44. Now, what are we thinking? Now, remember, 15 to 24, low volatility. 15 to 25 to 34, medium. 35 plus, higher volatility. Why do we care? Well, that is going to influence what the premiums are. Now, so if I went down and said, we're going to try to look to sell out of the money on the strike price just means the strike is above the stock price. Okay. Now, if we decided, hey, we're going to try to sell the 41 delta, which is the 50, we see the premium right there, 161, 174. Now, let's just kind of do some quick math, okay? Or we could actually just kind of say, look, we want to be a little lazy and just let it do it for us. But sometimes it doesn't do it. Let me actually pull this back up just real quick in that there. I'm going to pull up Love. Let me just bring up the ROR if I can. I don't get a percentage.
So if I look at this, if we got somewhere in the middle, let's say 165, okay? So if we got 165, which is the premium to agree to sell the shares at 50 from now till expiration. All right. Well, how much is that relative to what we purchased the shares for? The answer, 165. What do we buy the shares for? 43.65. So we're lagging into a covered call, 43.65. And we're seeing what's the option premium relative to what we bought the stock for. That is 3.7%. Some people say, look, I want to get a 1.5% minimum. 2.5% would be more medium, if you will. 3.5% would be higher. It's not completely surprising because the implied volatility was higher. All right. Now, that doesn't mean it's better. That just means that the stock is more volatile, and we're getting paid for that volatility in the form of the premium. So what we're going to do is we're going to click on that cell. I'm going to actually say cancel OCO group. Cancel the OCO group. Now on both accounts. We're going to come in, click on that 50. And what we're going to do is move it up to the mid price, 166. Now, so if we sell the call only, how do you sell the call only? Simple. Go down and actually click on the option you want to sell. And if we do that, you get just a single call. Now remember, if you have the shares already and then you sell the call, you're turning it into a covered call. Why? Well, you're selling the call because you actually think the price is going to pull back. So instead of just letting it pull back and having a dollar for dollar exposure, you're saying, I'm selling the call thinking that the price might be up near the high and trying to collect some premium because you have 100 shares. Send. Now, if we do that, I'm going to go, so it fills in the IRA, go back to the margin. Let's try to do that again. I'm going to go back in, cancel that OCO group, click on the exact same thing there, and we're going to move it to the 167, a little higher as we did this in the margin. Send again. Note the commission. Send. So now, I did not see UAL come across. Let's go type in UAL for just a moment. I didn't see that come across, and so I just want to make sure, did that trade fill? I don't think it did, and it didn't. So we're going to go right back in, and we're going to change this. Okay, we wanted 119 or lower. I'm going to have to now move it up 11 cents if I want to try to get filled. Confirm and send. Note the commission. Send it. Let's see if it fills. What we're trying to grab is the 450. Okay. So trade number one that we actually did is exiting one of the airlines. Okay. It's really more of a cash secured put. The second trade we actually did is take the love position, noticing where it actually was in the envelopes. And we're trying to go from a stock position to a covered call. When we actually go from a stock position to a covered call, we cap the upside in the short term, but we actually push the delta down. Now, why did you push the delta down? We wanted to push the delta down because if the stock went down, we want to have less loss potentially if the stock were to drop. Now, if we go sideways, we have positive theta, meaning that option could decay if time were to go by, making it potentially possible to try to buy that option back for less. Okay, now are there any questions with that? Now, so the other one I just want to look at, so love did fill on the margin. And now if we take a look at this, we got to talk about one other one just real quick on the CSX. Now, CSX, can anyone actually tell me, now the CSX, if we had 100 shares of stock, and we sold the call. Well, that's the covered call. Okay. Now, what you're now going to notice is we did not just have the covered call. We also bought the protection to the downside. Okay. Now, let me just draw this diagram just real quick. Where do we buy the shares? 40.13. Okay. Now, after this, we'll put on some newer positions, but I want to talk about this because, well, some of these positions, they're at the point of taking profits or rolling. We sold the 47.50, okay? And then the strike on the downside is we actually bought the 45. Okay. Now we got to ask ourselves, so that's the diagram. Now, is everyone with me? 4013 represents the stock purchase. Okay, that's not too bad. Now, the short call, you actually said, look, I'll agree to sell my shares at 47.5. And then you bought the put, you agreed to actually, you said, look, I want to sell my shares at 45. I want to have the right. Now, we got to ask ourselves the question, was there a debit or a credit? Now, right now, we collected $1.23, but paid 128. Now, I'm just going to say that it's pretty much offset. It's a nickel. It's not really, I mean, we could get into the details, but it's just a nickel. So we got to ask ourselves, if we just looked at this and said, look, let's just say it was a zero cost collar, okay, for the most part, what's the upside potential? Well, it's from 4013 up to 47.50. How much is that? My math is any good? It's $7.37. And we have 100 shares of stock. So the grand total could be at the most $737. Okay. Now we got to ask ourselves the question, how much do we have right now? Well, we have 674 of the 737. What would you do? Okay. Well, if you look at that, now my math is not maybe perfect, but that's 90% of the maximum gain. Plus, we only got 2 days remaining. Now, if the investor said, hey, look, I think it can continue to go to the upside, they might roll the position. They might take the June expiration and kick the can down the road to July. But let's say the investor said, you know what, I was kind of just thinking about profit taking. I wanted to actually kind of do something else with the capital and rotate to maybe some of these other areas. Now, if you said that's kind of what I'm thinking, that's funny because that's what we're thinking. Okay. Now, what I want to do in this case is I want to bring up, so how do you get out of the position? Well, if we get out of the position, how do we get out? We're going to actually go in and first what we want to do is try to get filled on the options. We're going to actually click on the options, hold the shift key down, okay? We're going to right click on this, create closing order, and then buy it back. Now, what you're going to notice is the options really didn't do very much because it stayed in between the strike. Which side benefited? The side of the trade that had the positive time decay. Okay. Now, how do you get out? Well, we're going to create closing order, buy it back. What does that really mean? We're buying the call back, and then step two, we're selling the put. Trying to. Confirm send. Note the commission there. Send the order. Why do you want to make sure that that gets filled first? Well, if we sell the shares first, well, and you have a sold call out there, you're in a naked call, meaning you do not have the shares to deliver at the short strike, the 47.5. So we want to make sure that gets filled as soon as we want to make sure that this gets filled. I'm going to go in and just change this to a market order so I can show you that. And then what we're going to do is just sell the shares. Now, if we did a market order, we're expecting that fill is not going to be as potentially good as the limit order. And as soon as that actually fills, if it does, right click there, create closing order, and then sell the shares. It's really not that bad. Now, the problem is if we wait inside 4 days to expiration, fills are probably going to be harder. Okay. So we just got to understand that as we're seeing. If that trade actually fills, we can just right click on the shares, create closing order, and then sell the shares. Okay. Now, I want to go back to something just real quick. So the comment was, Bill says, in a live account, this could have been exercised, and therefore the gain would have been only $45. Only. That's wrong. That's for sure wrong. Okay. So let's say someone took the shares at 47.5. Well, that means you would have had the maximum gain. Okay. because what mean in this case, you get all the premium. So right now we're sitting on a gain of $667. If someone called away the shares at 47.50, well, we would actually have what was it, like $730, 736 or something like that, maximum gain. We would be in a maximum gain situation. So here we are here, 677. If someone said, hey, your shares were assigned, which means your shares were sold at 47.5, if they call away, now let's kind of speak to this. If they take the shares at 47.5, you don't have any shares left. You got 0 shares. The call, it's gone. Okay. You don't have anything left. So what do you have left? The only thing you have left is the put. That's it. So if we said, hey, notice I went to my account and I don't have that cover call anymore. Someone took my shares. Well, the only thing you have left is the put that expires in 2 days that is worth 12.5 cents. Could you try to sell that? Sure. You'd have to check liquidity. Okay. But if someone called away those shares, you would be closer to and or at maximum gain. Okay. Make sense? Okay. Now let's actually go back to something. So now here's the thing. The funny thing about the collar strategy is, did we know which way it was going to go up? Not a clue. Not a clue. Okay. Did we think the trend was somewhat up? Yeah, we thought. You're going to notice, though, when you do a collar position, your delta is not as bullish as, let's say, buying 100 shares of stock only. Why? Well, because when you buy 100 shares of stock, the delta is 100. That's a profit loss if the stock goes up or down $1. Okay. Stock goes up $1, $100. Stock goes up $2, $200, and so on. Stock goes down 1, 2, 3, so on. It's just negative values. But when you sell the call, that's bearish in the shorter term. You buy the put, that's bearish. When we say bearish, it's negative delta, and it's offsetting the bullish delta from the shares. Oh, this is where it gets exciting. And now what you're going to see is it lowers the delta. Why would someone do something like that? How foolish. Oh, maybe not. Well, someone actually does that maybe when they think the stock's going to pull back, when they also think maybe the stock might go neutral to bullish. But the biggest reason why someone actually does it, they want to have a risk less than holding a stock position with the stop or no stop loss. The con is you cap the upside. Now, some people might say, I'm fine with capping the upside. Just want to make a little money. Okay. Okay. Now let's actually go back to a couple of Dow stocks we talked about yesterday. What's up with Amazon just real quick? Let's pull it up. Now let's talk about some new positions. Okay. We talked about UAL. We talked about crude oil. We talked about actually love. We also actually brought up the example of, let's go back to this just real quick, CSX. And now what I'm going to do is let's pull up just a couple Dow stocks we talked about yesterday. One of the Dow stocks we talked about yesterday, which we're going to follow through on, is Amazon. Now, when we talk about Amazon, we talked about the difference between Amazon and Apple. We said Amazon really kind of showed that condition number one, 10-period moving average going green. Yesterday, we saw also the moving average crossover. Step number 2. Remember, there's only 3 steps, so if you ain't paying attention, you just miss it. Now, remember, if this actually goes up higher and for longer, that 20-period moving average probably starts to go green. If that actually goes green, the 20-period moving average, step 3. 1, 2, 3. Okay, now, if you take a look at this, now, we'll come back to that in just a sec. Let's take a look at Apple and say, is Apple getting any love too? Well, now, we said yesterday, the higher that Apple goes, the longer that Apple stays above the moving average, that shorter-term moving average could actually start to go green. It did. Okay. Today, we're actually above that here. Now, here's the fallacy, okay? We think from day to day, you always have to look at different stocks. Why? Why? Have we learned nothing? Okay. Different stocks. You're trying to find the trends. and you're trying to ride those trends. And those trends that they make higher highs, higher lows, switching stocks from day to day to day, that means you're probably not riding those trends and squeezing every last drop out of that trend. Okay. I think one of the biggest mistakes, if you're looking at stocks and you're not really watching them day after day, week after week, you ain't riding the trend. Okay. And that's why you feel all over the place, because you are. Now, if we looked at Apple and said, James, I didn't like that setup yesterday. I thought it was a little early. Noted. But if the investor said, you know what, James, I actually see the word number one now. If we actually stay up, go up higher and for longer, the moving averages could start to, they could start to cross over. Now, let's go back to this for just a moment, okay? So let's say you said, James, I didn't like that entry yesterday, but it's followed through on what kind of the example we talked about. You can go to the trade tab. Now, the example given on the previous example, we have the June. Now, is everyone with me? Okay. Everyone come back. Let's huddle up. Okay. 260, 250. All right. Now, you only got 2 days left. So this trade squeezed 99.77% out of the rag, which could only get 100%. So what we're going to do is we're going to try to buy that short put back for a nickel or less, which should be commission less if it gets filled for 5 cents or less. Why are you not selling the put? Because it's at the 250 strike. That's a risk. Just note that. It's 2 cents. Okay. We're going to buy the short put back. Buy it back. Note the commission. Now, what we're going to do is we're going to get out of the Junes, and then we're going to go down to the Julys. Okay? 20 to 50 days expiration. Volatility, not 44, 23. That's what it feels like. I mean, compared to these other ones like AMD, ADI, and so on, you're thinking, ooh, volatility is boring. Okay, well, you got to remember something. Maybe you don't want everything in the portfolio to be like volatility of these stocks that have 100. I mean, you're trying, some things you just want to kind of want more of that potential smooth trend, not price action all over the place. So there's a trade-off. Now, the key word is potential trend. Now, if we came back in and said, look, we're going to sell the put again with a delta of 30 to 40, that would be really selling the 290. And if we open this up to a $10 wide strike, it'd be selling the 290 and then buying the 280. So now, if we went back and said, okay, what step is this on the chart? Step number 1, okay? If someone says, I don't normally like to do step number 1 for stocks, someone might say, I like step number 2 for, like, say, cash secured puts or short put verticals. Well, welcome, okay? People sometimes like that, consider options, because they're not dollar for dollar risk, okay? Less delta. If they're a little early, they can take a little volatility, and it's probably not going to crush the position if they're a little early. Is there still risk of downside? You better believe it. But they're doing a strategy that's not as sensitive. Okay? Now, we went back to this. We're going to sell the 290, buy the 280, and that's going to be 204. 204 divided into the risk, 796. You have about an ROR there, 204 divided by 796, 25%. Some investors say, look, I need 20% to even consider, okay? Now, when we talk about those percentages, we're talking about 20 to 50 days to expiration, okay? That's what we're talking about when we look at those percentages, okay? Now, if we take a look at this, note the commission there. So another trade, the follow through of Apple, and we're going to go ahead and send that order. Okay, now, if we went back to the other one just real quick, now, if you look at, let's say, Amazon for just real quick, Amazon looks like it's trying to make a little swing back to the upside. 260 is where it fell down from. If you said, James, I really want to maybe consider not buying the shares here. I want to kind of maybe go that long call vertical, see if we could swing back to the upside. Let's knock that down just real quick. It wouldn't take very long. Okay. Going to go to the July expiration again. Going to choose the first one at the money or in the money. That's the 245. If we widen this out, the 245, 255, 245, 255, if we could take that risk, what is the risk? Answer says 522. Could this portfolio take that risk? Well, sure. Okay. And it's going to be one contract. Now, if you take a look at this, we got the break even. We have the right to buy the shares at 245. And now you see the break even at 249. So it's the right to buy at 245, add the debit, and that's the break even at expiration, not today. So trade number 2, gonna try to add to that position, gonna see if we can get a little push to the upside. Okay. Now let's actually go back and look at some other ones just real quick. The other one we made mention yesterday was Caterpillar. Now, let me do a quick pop quiz for you, just real quick, okay? Now, everyone, get your hand on the clicker, hand on the keyboard, okay? Can anyone name to me, if you pulled up the industrial sector, name the stock that represents the biggest slice of pie in the industrial space? Speak now, type in now, forever hold your peace. Can anyone actually tell me what percent that stock is of the industrial sector? Oh, you're like, I knew you were going to do this to me. You darn right I am. Okay. Well, it's a small company called Caterpillar, the big yellow machine. And you're going to see that if that industrial sector broke to the upside, check me on this. I think it's actually Caterpillar 7.8% or so of the industrial sector. If you go back and look at correlation, okay, it's one of the few stocks that actually has the highest correlation. Correlation is historical. That doesn't mean that's going to happen in the future, but there's been a past history where if industrials go up, Caterpillar's actually gone up. We're asking this question is, could that actually repeat itself? Now, I want to kind of make mention of a couple other stocks. Now, we're going to do this. So Caterpillar, I don't have anything to say on Caterpillar besides it's in that sample portfolio. Caterpillar's right there, 10 shares. That was yesterday's trade. Don't have anything to say on that. However, what I do have something to say is other stocks that might be looking like they might try to go back to the upside is UPS, which is kind of right at the rim of the cup. There's your little drop down, right? Now remember, FedEx, it's already moved to the upside. So could UPS maybe get drug to the upside as well? 115, 120. Keep an eye out for that. Now, it's not just a big yellow machine. Other stocks like CMI are in there as well. Kind of looks very similar. The other one in there is GE, okay? And that has kind of a big, long cup to it. So those might be some stocks that the investors might be looking at in the industrial space. Now, I think if we kind of had to flag just 2 more stocks, which stocks that are semiconductor-based might the investor be watching maybe for a bounce continuation pattern? Probably ADI and AMD. Those might be maybe 2 stocks that poked, that's a key word, poked to a new high or prior high, red candles. Could those over the next couple of days continue to the upside? Act like I didn't tell you 2 other stocks. Let me add a third. Microchip, we're going to keep an eye on, and Marvel. Okay. And last one, I do mean this literally, okay, is Google. Now, I don't know why you kind of talk about Google sometimes. That one has kind of had your step 3 now. Crossover, 10 and the 20 moving average gone green. Little diagonal reversal as well. So keep an eye on some of these stocks. We kind of said which one kind of has a stronger setup of the ones I talked about just in the last 2 minutes. Probably Google, okay? Could it swing back to the upside? That 3-year weekly chart on that looks like your classic flag pattern on the intermediate chart. Keep an eye on Google. Not a recommendation, but I think some investors might be looking at it, okay? Now, out of my time here, we got Cameron May coming up next on Getting Started with Options. Also, remember that with what we talked about, you can actually go right to YouTube. Our channel on YouTube is, okay, Trader Talk Schwab Coaching Webcast. It's free. Okay. If you have not subscribed, just hit the subscribe button. If you enjoyed today's video, click that thumbs up so that way other people could actually see this as well. It was nice to actually kind of talk about some management of some positions, following through of some examples from yesterday, and also talking about some maybe ones to maybe keep an eye on over the next couple of days as well. Thanks to Barb for answering those questions in chat. And with that said, remember that with what we discussed here today, all investing involves risk. Be aware what the strategy is and why you might consider that. And this has really been the class on Investing Master Series, kind of mixing it up between stocks and options. Talking about timing and strategy. With that said, stay tuned for Cameron May coming up next. Bye-bye.